all things related to your money. Hey, Shelly, how are you? So I'm going to start. I'll make you the mod. We're going to be going live on the radio as well this weekend. So invite your friends. We're going to have a macro market discussion. The topic today is the market vomiting you out. We're going to be discussing boring macro market trends like TLT, what's going on with the stock market. If you have a question, we'll run it like my radio show. So basically, if you have a question, type it in the chat box. I will go to you live with your market questions. According to Scott Meinard of Guggenheim, we are in for a summer of pain. So, the summer of love in the 60s, now we're in for the summer of pain. And you know what? I thought it was a little bit negative and, S&P to fall 45%, NASDAQ to fall by 75% in the summer of pain, says Scott Meinard. And you just look at previous bear markets, if we're in one. Look at 2000 and 2002. Look at a 90% drop on the NASDAQ from 2000 to 2002. Look at the 50% drop on Bitcoin from November to today. According to Scott Meinard, this is probably, to be frank, why the market is having such a bad Friday. It seems like the media is now cranking up the fear and greed cycle. Now, if you have 10 years to hold your money, you shouldn't be worried about this. If you are a long-term hodler and you're committed to holding on for dear life, it shouldn't worry you. But it's fun to talk about, gets the financial media a buzz. But Scott Meinard's actually a friend of mine. I know a lot about him, so when he speaks, I listen. I will tell you, though, before I go into kind of a fearful market insider report from Scott Meinard and me, Josh Jalinski, the financial quarterback, the U.S. stock market will face much tougher conditions this summer, investor Meinard says. Our very own Stan Harley, who is rather bullish, says, when the year started, says, we may see Dow 25,000, folks. So you got to be prepared. Now, just so you don't think it's overblown or fearful, I will give you hope. But I'll tell you what doesn't give me hope. Talking or listening to people at the Fed. Neil Kashkari, do you remember this guy? He was the former interim secretary of the Treasury for financial stability. He is the Federal Reserve Bank president of the Minnesota Fed. When these Fed people talk, I listen. Why? Because they're clueless and their words breed them even more cluelessness. Minneapolis Fed Reserve Bank President Neil Kashkari on Thursday suggested that because household finances are in some cases in better shape than before the pandemic, and folks, if that is you, if you're in a better shape financially, type in yes on the Clubhouse chat or the YouTube chat. We are going live on YouTube. If you want to see my ugly mug, we're talking about macroeconomic trends. He says the Fed may end up needing to raise rates further to bring inflation under control. So the Fed is not getting the signal the markets are sending. He says, are these stronger balance sheets leading people to spend more and to be more confident to just change their behavior, their spending patterns? And is that more sustainable? In which case, maybe the Fed has to be even more aggressive. So you would see the price action, S&P down nearly 20% from its highs. Many bulls are ready to throw in the towel. You would expect them to say, you know what? We're going to pause the rate hike cycle. We're going to see what happens with this summer of pain. No, they are looking to inflict even more pain on the economy. It's almost like central planning. If anything, COVID has taught us, central planning, WHO, all these other groups, they don't work. People still live their lives. People are still psychological beings. What happened with COVID, right? Everybody freaked out. Market crashed 37% in a month. Then you know what? Somehow people took a deep breath and they said, you know what? We'll move on. The economy will go on. I'll be okay. I'll tighten my bootstraps. Eventually, people move on with their lives. So right now, my tip is don't let the financial markets derail you from your long-term goals on hodling stocks, on hodling Bitcoin, on hodling whatever you want to hodl, as long as it's not a crappy asset. Generally speaking, do you believe stocks will be worth more today, a year from now, or 10 years from now? Now, a year from now could be a bear market. 2 years from now could be a bear market. 10 years, probably stocks will be up. Probably Bitcoin will be up. So my point to all of you, and I'm not giving you investing advice, is don't let the fear-greed cycle of the financial media derail you from your long-term goals. Have an emergency plan in place. Have a volatility buffer. And you might say, well, what the heck's a volatility buffer? A volatility buffer is 1 to 3 years. Yes, I said years in bank products, treasuries, insurance products, fixed annuities, things that will not go down if we have a market crash, where you could drain your money from those accounts to weather a financial storm if you see a 50% sell-off in risk assets. Why am I getting concerned, and why is the market getting concerned this week? I see two common themes. One is everybody, yours truly, is becoming more bearish. That is generally a bullish sign. When everybody becomes bearish, it is time to be bullish. But we don't have everybody bullish. Not everybody is saying, sell all, sell all. Usually you see that in a decline. I believe we are in the middle of a broad market decline that could reach into September. Now, there will be rallies. I could see the S&P go down to 3,750 or 3,700, and then a rally, and then people say, the worst is over. And the S&P goes up to 4,100, and then boom, a trapdoor to hell drops open and swallows you up. Now, I want to realize, don't fear. If you have a volatility buffer where you can weather 1 to 3 years of living expenses in conservative assets, I really believe you have nothing to worry about. But too many of you were into meme stocks. You were into weird cryptocurrencies, whether it be Luna or some other scams or whatever it might be. And instead of having sound financial planning, if you went to a mediocre financial planner, they would tell you to have a 6-month emergency fund in the bank. You don't have to be a rocket scientist for that. Avoid debt. Avoid credit card debt. So there are sound things you can do so that you don't vomit out your long-term objectives. I have certain money that I am holding on for dear life no matter what, because I believe in the long-term thesis that risk assets will go up, and I'm just letting it be. Other assets, I have in more guaranteed things so I can sleep at night. Things like cash, things like cash value insurance. Maybe you have things like that. Maybe you don't, and that's why you're very worried. Things do not go up forever. There are boom and bust cycles pretty much historically. There's the panic of 1837. There's the crash of 1929. Maybe it's the crash of 2022. I have no clue. Neither do you. No one exactly knows the future. But we can prepare. We can have sound financial planning. That's why financial planners advocate diversification. It's not that they're dumb and they don't realize that everything will go down when you're diversified. Yes, everything will go down, but some things will go down less. And some things will be principal protected. So I'm very worried. I mean, what's also interesting is for the first time in a while, treasuries are starting to decline in yield, and they have gone up significantly in value. TLT, which started the week around 116, we own it for some clients, it's now up to 118. So as other assets went down, the flight to quality move is going up. So do you have a question about your money? We are live taking your questions. If you have a question in the chat box, just ask it. We're here for you. Take a deep breath. Follow sound principles of behavioral economics. On tomorrow's show, I will be revealing some behavioral economics tips to help you navigate a decline. So Scott Minerd, and here's the thing, your portfolio should not matter what Scott Minerd says, but he's a friend of mine. He's a smart guy. So let's talk about what he's saying. Stocks are in for a grim summer with the NASDAQ Composite and the S&P 500 in for huge slides, according to Minerd. Now, I think he's just waking up and seeing the news that we've been reporting since January, which was, if you look at Facebook, if you look at Netflix, they were the canary in the coal mine. Netflix is down, and I'll get my Netflix chart. Were you able to show that on the YouTube screen? See if we can. Netflix started out the year, get this, $597 a share. They have had a catastrophic loss of wealth as it is now trading at about 182. But as everything else had a bad week, because Netflix had a bad year, the floor seems to be holding somewhere around 182, could go lower. But now Netflix is trading at a price to earnings ratio of 16. It's coming back, gravity. It's financial gravity. Stocks generally trade with their price to earnings ratio. If multiples are too high, a bear market has a way of regulating price to earnings ratios. So I'm going to take a brief break. And when I return, I want your questions at 800-321-0710, or you can type in the chat box any financial question you have. It could be on the market, could be on your portfolio, folks. And call my office now. We're standing by live at 888-988-JOSH to give you a 45-minute wealth blueprint. If you call right now within the next 3 minutes at 888-988-JOSH, I will score your top 3 holdings from a standpoint of risk, fees, and taxation. So call now, 888-988-JOSH, or you can ask me a financial question free right now. Just type in the chat box. I will call you up at 888-988-JOSH. Give us a call now. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback. So Netflix plummeted nearly 50%, but I guess it was about 25 to 50%. That first leg down, January 25th, 2022, when we saw the first big sell-off, the S&P dropped below its 200-day moving average. Bitcoin had a significant low in the end of January. We've since taken out those lows in the S&P. That makes me more bearish from a technical perspective. But hey, all these things can change. You got to realize these indicators, as quickly as they go negative, they can go positive in 2 weeks. And then people say, now is the chance of a lifetime to buy equities. So my point to you all is have sound principles. I was laughed at the other day because I told somebody in a Bitcoin chat room to have 1 to 3 years of cash. And they said I was an idiot, or, they started making fun of me. The whole idea is if you believe that something is going to be long-term valued more than what it is today, I'm talking 5 years from now, 10 years from now, do you believe stocks will be more than they are today? Then you really shouldn't worry about the market unless you don't have a sufficient volatility buffer. So that's my big tip. Don't fear, get a volatility buffer. Other tip, get your holdings scored. I'm going to go through assets, though, that show some promise for the overall economy. Netflix. You might say, well, Netflix, it's like 20% of what it was valued at before. Yes. So what that shows you is things could lose 80%. Those tech type stocks that everybody was raging about, they could lose 80%. And you might say, well, that's ridiculous. It happened before, folks. The NASDAQ saw a peak to trough decline of somewhere between 60 and 90%. People forget Amazon was once a $100 stock. Then it went to 10 in the last crash. 10. That'll happen again with risk assets. You might get the chance of a sale of a lifetime between now and the next 2 or 3 years. Maybe the Fed comes to the rescue and says, we're going to lower rates. We're going to start buying treasuries again. I will tell you, based on what I'm seeing, the Fed is not in a dovish mood. They firmly believe, just like the WHO believed they could tame COVID. And what are we? 2 years later, nobody can really tame it. You can't tame God. You can't tame nature. You can't tame viruses. You really can't tame markets. Markets will act irrationally on the upward axis and the downward axis longer than you ever realize. That's why it's important to be conservative with your money. So invite some friends. I'm Josh Jalinski, the financial quarterback. We'll be taking your questions on all matters financial. We're talking about Scott Minerd, Summer of Pain. And I want to get take a pause. If anybody wants to come up and ask a question or to just give a comment, do you believe we will have a summer of pain? Or will the summer of pain turn into the summer of lame? There was a year that seems very eerily similar, where the bears were freaking out. Everything was going to go down. The Shemitah was upon us. By the way, it is a Shemitah year. Every 7 years in the Bible is supposed to be a year of turning, a year of sort of great change, uncertainty, economic upheaval. 2015, a lot of people were worried about that. Remember the blood moons? 2008, I heard whole sermons about the blood moons. People were very worried. Okay, the end of the world was coming in 2015. Didn't really come. 2008, people thought the end of the financial markets as we know it. It seemed like it, but we survived that. 2000 and 2002 was the end of the dot bombs. The dot coms turned into the dot bombs, but we survived that. So we as humans have the ability to think about risk, to freak out about it, but then to make peace with it and then go about our normal lives. It's a very interesting way that we're kind of hardwired by our creator to freak out, almost have this fear, greed response, and then, yeah, you know what? The market's down. I'm not going to look at it anymore. You kind of get this capitulation or this hopelessness. Oh, the market, it's never going to really do well. So I'm not going to be in it. And that's exactly when it starts to turn. I remember people were so bearish in 2010, 2009. They thought the Dow would just always be below 10,000, that it would never hit 10,000 again. So Netflix down 80% peak to trough. Let me get the exact date range. If we go to, I don't know when the peak was, maybe 12/1/2021 to May 20th, 22, 71% decline. If Netflix can go down 71%, I guess this is why Scott Minerd says NASDAQ type stocks can go down 75%. It's not like he's a rocket scientist. He's a smart guy. He's looking at the data. Interestingly enough, and this may show hope for the economy, Meta, which pretty much had the worst thing happen to it as Facebook was banned from doing certain things by Apple due to iOS changes. Basically, it can't spy on you as much as it used to. You might say, I don't use Facebook. Well, you might use Instagram. So that's down 41%. So for him to say that 40% declines in the S&P and 75% in NASDAQ-y type stocks, you just look at what happened to Facebook and you look at what happened in Netflix and say, and I'm not recommending you buy or sell trades like, is Datadog really any better? Is Lemonade really any better? And probably not. I'm not going to tell you to buy or sell anything. But my point is, Summer of Pain. So Scott Minerd comes out. Minerd attributed intense ruckus in the markets to the Fed's tightening monetary response. Now, just so you don't think, I want to dispel the myth of these bears that will come out, because they were all bullish a few months ago. Everybody will come out and be bearish because the data is now bearish. A month or two ago, I could look at the same Minerd quote from 2 months ago. The Fed should tighten more. But Minerd attributed an intense ruckus in the markets to the Fed's tightening monetary policy. Oh, duh. The stock markets are in for a grim summer, with the NASDAQ taking huge slides. In an interview with MarketWatch, billionaire investor Minerd, they own a part of the LA Dodgers now. He's a great guy for a billionaire. I met him. I love him. He compared the possible implosion to the dot-com bubble burst of the 1990s. That looks like the collapse of the internet bubble. Minerd's pessimistic outlook is fueled by the Fed's aggressive tightening monetary policy, where interest rates have been lifted rapidly. Comes in response to soaring inflation as a result of the pandemic-era fiscal support, global supply chain blockages, and surging energy and commodity prices from the Ukraine war. He said the Fed is likely to raise rates even further until inflation cools down and until they see a clear break of the inflation trend. If that means the Fed will dial up the benchmark rate above what is considered a neutral rate, that's what will happen. With the passage of time, as the Fed continues to hike, we will likely find ourselves experiencing the effects of increasingly restrictive monetary policy. Well before it reaches this terminal rate, the Fed will increase the risk of overshooting, causing a financial accident, which is what is happening now, and starting a recession. With more possible rate hikes pending, Minerd said a recession will be hard to avoid. He echoes sentiments expressed by other industry experts, including Goldman Sachs CEO David Solomon, who recently said there's a reasonable chance the economy will enter a recession. He added that the Fed wrongly appears to have few concerns about a bear market in stocks. We are probably going to have a pretty severe sell-off. U.S. stock markets have been caught in a brutal storm this year, with the tech-heavy NASDAQ and the S&P 500 plunging. On Wednesday, U.S. stock indexes fell further, suffering their biggest one-day loss since the peak of the pandemic, with the S&P losing 4% and the NASDAQ falling 5.1%. Despite volatility in the market, the Fed is unlikely to cushion stocks from sliding even further. What's clear to me is that there's not market put, and I think that we're all waking up to the fact of that now, meaning the Fed is no longer providing the Fed put, which they would come in anytime there was a worry and they would come to the rescue. Now, will they get to their buddy Biden? The Fed is now a political institution. For those who say that is not the case, just look at who our Secretary of the Treasury is, former Federal Reserve Chairwoman Janet Yellen. Next up, we're going to go to Jorge. You have a question. We're live on the radio. This is Josh Jalinski, the financial quarterback. Go ahead, Jorge.
Hey, Josh. Thank you. So I guess, I've been reading about the history of bear markets and, having studying history, especially financial crisis and those kinds of things, is really important because, as Ray Dalio pointed out in his last book, everything goes in cycles. And if you know the cycles, you know actually what happens next. The only thing you don't know is when, right? So, for instance, the devaluation of the dollar, they could kick that can down the road for a very long time, longer than many of us expected. You know what's going to happen, but we just don't know when, we're going to see the end of fiat, for instance. So, in looking at the history of bear markets, it seems like there's four stages. There's the initial decline, there's a relief rally, and everybody is lulled into thinking, oh, wow, it was just a correction. We're back to normal. But then they realize it's not, because then you have this precipitous drop. And then there's ensuing panic, and everybody's selling. And nobody wants to buy because they realize it's not a correction, and it goes down to the bottom. And at the bottom, then you have some astute investors who are thinking, wow, we have.
Oh, go ahead. Okay. Until we get Jorge back on, I'll keep referencing this article. So basically, Scott Minerd says there's pain. Mohammed El-Arian says the stock sell-off is in a new phase as investors add earnings and growth fears to Fed worries. A lot this week was taken aback by Walmart and Target's dismal showing, where it really created a problem for the stock market as people are wondering, what the heck's happening? If Target and Walmart fail, could that mean others? So give us a call. And Jorge, we're going to go back to you. Cut out for a second. Go ahead, Jorge. You're talking about Ray Dalio's
Oh, sorry. Okay, I was just
cycles
saying that.
theory, which I generally subscribe to.
Can you hear me?
Yes, go ahead.
Okay, so that was all the prelude into the importance of studying history, so you know where you are in the cycle, what comes next. The only thing we don't know is when it's going to happen. That said, I was saying that I was looking into the history of bear markets, and they seem to come in four phases: the initial decline, a relief rally, then panic, and then the bottom. And so the question is, are we coming into a relief rally? Have we had one? Because for instance, for me, I'm going to move into cash positions. Not yet. If we're going to have a relief rally, I'd rather have that happen. So, what are your thoughts on a potential relief rally?
Relief rallies in a bear market, if that's what we're having, are very sloppy and hard to predict. Similar to earlier in the week, we had like a 1,400 point rally on the Dow out of nowhere. Do you remember that? So it happened. Nobody really said, hey, sell off. People thought it was going to be. They're going to happen in fits and spurts. If I was a betting person, which I don't believe you should gamble your life savings, we're close to the first wave of the leg down. Maybe it's 3,750, maybe it's 3,800, maybe it's 3,836, 3,850, something like that. If I'm not suggesting anyone trade based off this, I could see the S&P, which is currently about 3,850-ish, go down to 3,750, maybe even 3,700, or hold firm where we are. If we hold firm, then we could have a brief rally into June. And that's your relief rally. And then a massive leg down this summer as investors wake up. They get their statements from May, somewhere in the beginning of June, and then they start selling indiscriminately. And then from June to September is really the first broad base decline. Now, within bears, you normally have about a 18-month to longer cycle. We tend to think of bear markets as short because December 2018 was a negative 20% month. March of 2020 was a negative 37% decline. So people think, oh, it's going to rally quickly, right? So what I think is going to happen is we're going to have this deep sell-off, and we may have the Fed come to the rescue around September. It's going to cause a massive rally, but the rally might only be 25% higher. But then we're still whatever, 25 or 30% lower than we started, and then, you know, the bottom falls out. But I don't think you trade this market based on the 7-year cycles theory. I think you take it week by week. You understand 7-year cycles. You understand bear market cycles. I mean, we have a cycles guy on staff who knows more about cycles than Ray Dalio ever knew. And Ray Dalio probably got the information from Stan Harley, who's been on my show plenty of times. There's that 94-year war. There's a war cycle. There's a depression cycle. Think of Panic of 1837, crash of 1929. Maybe we're here. Crash of 2023 would be the exact, I think, time period. Maybe it's a year early. As the cycles people say, when the cycle doesn't exactly move, they say, well, you know, it can plus or minus a few years, you know, it can expand or contract like an accordion. That's true, but you got money, you got to protect now. So that's why I'm a big advocate of having a plan and not having in the market to begin with what you are uncomfortable to lose. So we're going to go to a follow-up from you, Jorge. Then we're going to go to Mike, who has a question on real estate. Folks, he lost 150K, 150,000. A lot of people are losing money in this downturn, Mike. Don't worry, we'll answer your question when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. We're going to go to Jorge. Do you have any follow-up questions on that, Jorge?
Yeah, I do. So the reason for my looking at the relief rally, I mean, everything's very correlated, right? And, you know, some people here know that I have Bitcoin and, you know, you don't touch that. But as far as like the equities that are in, you know, tax sheltered accounts and so forth, the reason I'm looking for the relief rally is because, yeah, I agree things like the FANG stocks, you know, I just think that they're going to get obliterated, just my opinion. But I'm looking and saying, okay, what does well in this kind of environment? And I'm looking at commodities because, you know, everything is interrelated. You know, everything is like, it's all I mean, nothing is isolated. So this situation with the invasion of Ukraine, where sanctions are being put on Russia, okay, granted, those sanctions are meant to hurt Russia, and I am making I'm not in favor of any country ever invading another country. But the fact remains that those sanctions, people don't understand. It's like a boomerang. It's going to hit Russia, and the boomerang is going to come around and hit us too. And so what we have is people don't understand Russia is a commodity superpower. They've got like 13 commodities where they're either the number 1, 2, or 3 exporter. Okay. And so a lot of that has to do with food. And you're going to have this decrease in energy, but people don't tie the fact that energy is very much food is very much pegged to energy. Without energy, you can't grow it, you can't transport it, and all those things. And so when I hear that Belarus and Russia are 40% of the exporter of potash, people don't understand what potash is. It's potassium, right? It's an integral part of fertilizers. Okay, that is not leaving. And then we talk about natural gas, but you have to talk about the stuff that's made of natural gas, like ammonia-based fertilizers. Then the fact that both Ukraine and Russia combined are 30% of the world's wheat. Ukraine's the breadbasket of Ukraine. They also have like 13% of the exportation of corn. And you have all these seed oils. And the fact that the world is becoming more deglobalized, okay, as our, you know, we have, you know, the breakdown of our, you know, the exportations, the word slipping. But anyhow, all these things are happening. And then I'll read that we could face some serious food shortages, right? So I'm looking at, for instance, potash royalty companies. I'm looking at, okay, who's got copper and nickel and cobalt and all the things that Russia has in abundance, and the fact that it won't be able to come out is going to affect the world in one way or another, right? Because a lot of these things like palladium, which goes into the carburetor of your car, or some of the, or they affect the cell phones that we're communicating with, or our laptops, or, you know, the production of steel, and Biden wants to have this infrastructure. All this stuff is interrelated.
And I think that within the next 12 to 18 months, we're going to see some serious effects and consequences of these commodities that are hugely important for the stuff that civilization is made of will not come out. And I, as an investor slash speculator, want to get in front of that. So hence the bear market relief rally. You know, if I'm going to free up cash, well, I don't want to get out now. If it's going to go up, I want to get out then, and then put it into some of these other things. So what are your views? Have you looked into commodities and those kinds of things?
Yeah, we're looking at commodities in general. There's always a bull market somewhere. So you might have, with this downturn, you may see very positive strength for things like annuities, things like insurance contracts, which might be buoyed by higher interest rates on fixed accounts. Commodities, gold. Gold miners have been beaten for a while, years. And kind of a flight to safety may send gold, may send treasuries up, and may send commodities up. So we have something called the permanent portfolio that I'd like to share with any of our listeners who call us. You can give us a call, 888-988-JOSH, and share with you that we've back tested in different environments and seen, how it may have performed. Although with any back test, it has flaws. But, in negative environments, treasuries tend to do better. If we see a 40% sell-off in stocks, as many are suggesting, that may send TLT higher. That may send treasuries higher. I'm worried, though, about the Fed does not seem to be getting the message. I'm worried that they're going to continue raising rates. I mentioned this article earlier, the Neil Kashkari article, and I'll go to that next. Kashkari said that because so much is beyond the Fed's control, supply chains, for instance, which in their currently tangled state are pushing upwards in prices in ways only that is getting worse, with China's lockdowns and the Russian invasion of the Ukraine. We know that we have to get inflation down. We are going to do everything we can to achieve a soft landing. But I'll be honest with you, I don't know the odds of pulling that off. The odds are quickly going to zero. The wealth effect is a real thing. So notice this. Listen to what he's saying. Listen to what he's saying. The Fed knows about the wealth effect, and they actually want the wealth effect to go down. This is from Neil Kashkari, Minneapolis Fed Reserve president. The wealth effect, this is from Reuters, is a real thing. Those who have stocks have higher 401ks. They feel more confident. They go out and spend more. When those things come down, it may change their behavior. Though the Fed does not target stock prices, we do pay attention to that feedback. That, I believe, and this quote that came out yesterday is a reason why you're seeing a deepening of the sell-off. It's a realization that the Fed, they know about the wealth effect, but they don't even care. They're okay with a 40% decline in stocks because it can then perpetuate the myth of their greatness when their interest rate hikes stave off inflation. I believe they know this inflation is COVID supply chain related. I believe it's all about killing the wealth effect. So I'm worried. And if you read between the lines, Fed Reserve President Hester, she's saying they need higher rates. It's just they're not even understanding the feedback loop. So you would think if they had half of a brain, they would say the S&P is down 20%. Let's revisit this. No, they want a bear market. They want to show how strong they are. That the mighty Fed can stop inflation. Yeah, you can stop inflation. You could just destroy the wealth effect. So I do have a tip for everyone. Central planning does not work. Central planning on COVID didn't work. The WHO was proven to be fallacious in many things they're saying, and it did nothing to stop the spread. Any of the things that they told us were going to stop COVID, people still Sad to say, we still lost many lives due to COVID and central banking idiocy, central planning health idiocy. Now we're going to central banking idiocy. So think about this. For years, they've told us they are an apolitical organization. They're not political. Then what happens? Janet Yellen, Fed chair, then goes to become a political appointee as Secretary of the Treasury. They should be banned. Fed people should be banned from then taking a role like that. But no, they're allowed to just go get a tenured professorship at Princeton, never have experience in real life. They're not paying attention to what's going on in Main Street. People are not doing well, and the pain is only very real. So we're going to go to your questions, folks. If you have something in the chat box, and folks, give us a call during the break, 888-988-JOSH, 888-988-JOSH. We'll be back after these messages. Okay, we're back. This is Josh Jalinski, the financial quarterback. We're going to go to Bitcoin Tina. What's your take on this whole wealth effect thing? This is just, I was shocked when I read that. Well, not really shocked, because nothing they do is now shocking anymore. But this Reuters article, I don't know if you saw this, where they understand the wealth effect, but they don't care. What do you think about it, Tina?
Well, I think that the Fed has been using the wealth effect for decades already. I think they've been aware of it for decades. They use it as a policy tool for many, many years for housing in benefits of what's called cash out refinancing. So when rates go down and the value of homes go up, people are able to easily take wealth out of their home. It's debt, so there's no income tax on it, and still have the same monthly payment. So I think they've known about this for a long time. I think they've known about it in stocks for a long time. My guess is that this is going to be a period which gives the Fed, a couple of broken arms, a couple of black eyes, some broken legs, because I think that I disagree with them fairly strongly. I think this will actually, I think this is reckless policy. And my fear is that it's like standing at the base of a major dam and pulling, some pieces of the dam away from it, exposing the water, and figuring we can control the flow here. I don't think they can control the flow. I think they risk starting a cascade, and I think we risk going into a severe downturn. And it's not going to begin with an R; it's going to begin with a D. So I just think it's a very reckless, very dangerous game. And as painful as inflation is, I think they're going to find out that falling asset prices, i.e., houses and stocks, are not just going to affect wealthy people. I think it's going to affect the entire economy, because I think that the wealth effect has been significant in driving consumption over the last several decades. So I think this is an enormous problem. I think this will go down as a disastrous mistake. We have to see how it plays itself out. I expect that there will be a reversal of policy on the Fed. I think Congress will have to step in, but I think it will take a lot of pain on the downside for Congress to step in, because we're in an election year. It's going to be highly contested. There's not going to be an agreement. And then the question is, even come next year, if Republicans take both houses, which I expect, that they may not want to work with the White House. There may not be an agreement. Republicans may say, we want tax cuts. Democrats say, we want spending. And I think eventually they'll come to agreement, but it will be a lot of Neros fiddling while Rome burns. So I think this is very dangerous. My favorite chart that I show all the time is comparing stock market cap to GDP, and this hit an all-time high of 2.5 times. For comparison, in the year 2000, it was approximately 1.2 times versus currently the peak at 2.5 times. And in 2007, it was at 1 times. So stocks can go down quite a lot. I believe housing can go down quite a lot. And I think this will be notable. I think this will be. I'm extremely worried. I think it will be catastrophic, and I think the outcomes will lead to very severe downturn that the Fed will not be in position to control. I think they basically took an economy which was likely slowing and then gave it a good shove down the hill. And it was not smart. I don't think what they did. I think what they did was incredibly dumb. And I think there'll be a terrible price for all of us to pay. It's not the Fed that's going to pay the price. We're going to pay the price. These are people who don't feel any pain. And it's very unfortunate.
Yeah, they have tenured professorships, pensions. It was interesting. I had Barry Dyke on the show a while ago looking at what did the Fed people actually do with their money. And it was very surprising. Do you know where they have their money? Mostly it was like TIAA guaranteed like 3 to 4% fixed annuities. They're generally very conservative people who don't care, it seems like, what happens. Well, they did for a while with the wealth effect. I argued for quite some time that they should have been raising rates ever so slightly during the Obama years to bring them back to normalcy, but they didn't because they were all sort of, political appointees and maybe leaning one side of the aisle, and they didn't want to have more pain for their particular political party. So they waited till, basically December of 2018 to start raising rates. That didn't work because Trump started lambasting them. And, the Fed chair, which used to be a very respected title, kind of is now a pariah due to all of the things that Trump kind of said. And, I think the next crash will be the undermining, meaning the undermining of the Fed put. If people do not believe that the Fed has a put, that could send markets reeling. But like you said, when will they act? I don't think they act till we have a 40% decline in the S&P. Are they really going to act now? They all said they haven't, unless they're all lying. This week, I'm looking at every report this week to see has there been any softening of their hawkish stance. Now, hawk, if you don't know, belief that the Fed should raise rates. Dove, generally lower them or be more accommodative. Kansas City Fed president. So we got Neil Kashkari, who, by the way, was around for the '08 crisis and was one of Geithner's people. And, so they pick people right out of, they failed the first crisis. So let's give them another economy to fail. Kansas City Fed President Esther George said Thursday that higher interest rates are needed to bring down inflation. She added in a CNBC interview that the efforts to bring down inflation will result in tighter conditions, of which the stock market is a part. George expressed confidence that the Fed, which targets 2% inflation, can bring prices down through rate hikes and reducing the $9 trillion in asset holdings on its balance sheet. So apparently KC Fed President Esther George is also tone deaf. And you could look at everybody from Powell. He says Fed plans for a half-point interest rate hike won't be shaken. And I think this is why you've seen the markets really go down significantly this week after having we had those two bullish days early in the week where the market was up like 1,400 points on the Dow. And those are the types of rallies, though, that happen in a bear market. And what was a strong economy is now looking pretty weak. So, folks, type in the chat box if you have a question, financial comment, we'd love to hear. San Francisco Fed President Mary Daly, interest rates to move expeditiously higher. I mean, these people just don't get it. But that's what happens when you have political appointees. This is like exactly what happened with the WHO with COVID. Central planning never works. It's what's happening with the environment, right? Everybody's buying Teslas now. I don't know. Has anybody want to comment on this? I don't know, but my home has experienced more like blackouts or brownouts A little bit here, a little bit there, than ever before. I think it's because everybody has a Tesla in their home now. And the amount of energy that it's sucking from the grid. I never had grid issues. We were in the middle of a hurricane zone during Hurricane Sandy, and the power was out, I don't know, maybe a day. Now we'll have power outages here, power outages there. It's what happens when you have environmental mandates and then you get rid of nuclear. Our grid can't handle this. So, you have all these manufactured crises, food shortages, COVID, not manufactured, but where the government response, environmental, but the government response or the central planning response doing nothing. In fact, making things worse. If the Fed just kind of kept rates pretty low, yeah, we might have had a slowdown, and maybe what our terminal point on the S&P would be where it is now. Now it's looking much, much lower. For us to break 3,900, now I think we could go as low as 3,750 before I see a relief rally. But man, this is huge. We have Mike who has a comment. He's asking, is deflation even going to cure supply shortages? Is that even possible? Is stagflation coming or deflation? I don't know. The stagflation versus deflation argument's very hard because certain things deflate, certain things I think we're already at, I guess, the stagflation moment. I don't think deflation cures supply chain shortages because we're having energy issues. We're losing, Ukraine's output, which is minimal. But when you add all these other things, you have U.S. farmland being bought up by Gates and other people, which, is the stuff of conspiracy theories. But he owns a lot of farmland, and they're not using that to raise dairy cattle and wheat and corn. They're raising soy so that we can eat synthetic meat. So, it's weird, but that's all that central planning nonsense to cure the environment because farting cows are too much. So I'll go to the questions. If anybody has a question, you can raise your hand. We'll bring you up. And folks, if you have a question or financial comment, but S&P at 3825 is not pretty. Dow at 30,734. I think that'd be a good question. What is the level the Dow has to be before the Fed starts taking some bold action? I would say 25,000. What do you say, Tina? Because I don't think they can act quicker before.
I really don't know, Josh. I really don't know the answer to that.
And by then, do they lose all credibility? We'll see.
I'm very frustrated because I get people's frustration with CPI coming from supply chain issues, but the solutions to those things are, we need nuclear power in this country. We need to address drilling. We need more drilling in this country. Nuclear power, will take years to come to be meaningful. It takes years to build these things. We really have to change a lot of the things that we've done in the last 30 years. We have to have manufacturing back in the United States. There's a lot of things that can be done, but none of them can be done instantly. And I don't know. I find it very frustrating to see what's happening. My guess is that we'll end up seeing an overreaction on the other side because the pain will be substantial. And so this is just like, I once heard a commentator say that the Fed goes from ditch to ditch. They're in a ditch on one side of the road. They gun the engine. They go flying over the top of the road and land in the ditch on the other side of the road. But it's not just the Fed. We'll also, I expect that we'll see massive fiscal stimulus, and I expect that we'll need massive fiscal stimulus because I think that the markets, capital markets, that stocks, real estate, have become so large relative to the real economy that it will affect the real economy. I think it will affect the real economy in a very serious way. I think it will affect jobs. You take enough out of these markets, out of real estate, out of stocks, I think it will affect the employment market. Now, it won't affect it tomorrow or the next day, but 6 months from now, a year from now, I think it will affect it very negatively. I think it'll be a massive overshoot. Central planning doesn't work.
It's already
We've
happening.
lived in a centrally planned economy for decades already.
Yeah. And the sad thing is the central planning doesn't work, meaning we spend how much during the COVID relief? Numbers are between 5 and 10 trillion. We really never had an audit of that. Couldn't they have used, because everybody wants to go green, couldn't they have used $1 trillion of that to place nuclear in key parts of the energy grid and update the energy grid? They never do. It was just like when they said infrastructure, they build these bridges to nowhere. The government is always inefficient. I live in New Jersey, and our infrastructure could use a lot of work. They didn't fix the tunnel into New York. They didn't add extra railway. What they did instead was it depended on the congressperson and what they had earmarked. So at that time, there was, I guess it was Jeff Van Drew's district in South Jersey. They spent millions and millions of dollars remaking a bridge to Ocean City, New Jersey, so that they would have a bike path. And who goes on the bike path? It's for well, why didn't they add a lane so it would reduce congestion? They never do smart things with these stimulus plans. With the COVID relief, that would have been a great time to say, you know what, we're going to get all these people out of work. We're going to have all these engineers and this kind of Marshall Plan for nuclear. It will never happen. Instead, with the Biden infrastructure plan, okay, we need Teslas everywhere, superchargers everywhere, charge point stations everywhere. So then all of a sudden, our grid will break. They know what they're doing. Any idiot would see that. But it's all about then they're going to say, well, you know what, you consume too much energy. You're going to have to set your thermostat a certain level. You're going to have to change all your light bulbs, all of these things, which are really a drop in the bucket. It's like the boy with the finger in the dike. So, okay, next up, we're going to go to Jorge, who has a question, and then Christine. Go ahead, Jorge. You're on with Josh Jalinski, the financial quarterback.
Yeah, thanks, Josh. So my question also is for you or for Tina's comments, because I'll reiterate, I think that I agree with both of you. This is going to get a lot worse than most people are thinking. I worry about a potential bear market rally that people think, oh, it was just a correction, and then it goes 30 or 40% lower after that. And people are going to get wiped out, in that panic phase. But, again, I tie everything in. It's just not what the Fed is doing. It's like the whole Ukraine issue, the sanctions, commodities not coming out. This is tied into energy. And food is tied into energy, rising food prices, and those kinds of things, which is just going to make everything a whole lot worse. But the one thing that I question, this weaponization of the dollar through the SWIFT sanction that we imposed on Russia. Well, we've had other, SWIFT sanctions in smaller countries, but the only major country that has been de-SWIFT in recent years was Iran in 2011, and that was devastating to their economy. The Russian economy will slowly suffocate without access to SWIFT. Still, Biden went further. They not only kicked Russia commercial banks out of SWIFT, but also kicked the central bank of Russia out of the system, except for certain transactions that may be approved on a case-by-case basis. So here's what Biden's team doesn't seem to understand. Every payment, every trade has two sides. So when you blow up one side, Russia, you also blow up the other side, the world banking system. And linkages are dense and immensely scaled. And my worry is that this will spill over into a global liquidity crisis. Am I seeing this incorrectly, or is that a possibility?
No, I'm definitely worried about a global liquidity crisis. I mean, I thought we were a year away from it, but they're accelerating it. quicker than anyone can imagine with their stupidity. You would think that the Fed would say, this is what happens when you have Fed Reserve, and I don't envy their position. I think they're between a rock and a hard place. They really don't have much at their arsenal to do, but I think when you've had years of accommodative policy and they want to tighten, you're just going to have weird effects. The question was always whether 2022 would be the top or early 2023, and it looks like January 2022 was the top. And if you study history, these global liquidity crisis tends to happen. We seem to have a tremor in the market every 7 years, 87, 94, 2000, 2008, 15 was a rough year for a period of time, 2022. I mean, it could turn out to be 2015, but I think there's so much working against it right now that we could very well have a global liquidity crisis a la in 08. I hope not. I wish them luck. But I think when you try to raise rates when the economy is very weak and the inflation that we're seeing really is due to exogenous events like, but it's because it's real. So it's here to stay. You can't print money forever. That's why fiscal conservatism and governments should not have excessive debt. But nobody listens, bread and circuses. So,
well, unlike those other crises that you mentioned, we've never been at this level of debt. I mean, not just us, but the world. And, I keep talking about this, but it doesn't seem to come up. Everybody's very aware of the fact that we have 29 trillion of debt, as compared to our GDP, which is around 23 trillion. But people don't talk about our unofficial debt, right? The unfunded liabilities across the infinite horizon, which, again, I have to put this in perspective. So you read lots of different reports, and I don't know. I read one where the world's GDP is like 80 trillion. Well, our unfunded liabilities are, at last I checked, $160 trillion, which comes out to $465,000 per every man, woman, and child, whether you are a newborn or a geriatric. Right?
Yeah, I always go to that usdebtclock.org.
Yep.
169 trillion in unfunded liabilities. I wonder how much effect, COVID had, though, on the Social Security Medicare liabilities with how many deaths we saw. They haven't been updated for that, but I think it's 508,000 per citizen, and there's only 582,000 in assets per citizen. So what is the government just going to do? Take everything? I mean, I think they're going to have to do three things to get out of it: massive austerity, higher taxes, lower spending, massive pain to get out of this. I remember when I will tell you, things are usually worse than they actually occur. Because I remember I used to do talks. This is when I was in my 20s on usdebtclock.org. And I worried about it years ago. I read the book, The Coming Generational Storm, which talked about this unfunded liability problem. So are we now at the point where the chickens come home to roost? Is that 2023? I hope not, because that could be, significant economic pain. And people were talking about that COVID 2020 would spiral us into that death spiral. But no, debt matters. It's why the U.S. national debt should be under control. Global debt to GDP should be under control. But, people are just not doing that. They just print themselves. That's when you have fiat economies. It's what happens. So, folks, we're going to take a break. When we return, we'll be back with a question from, I believe, Rob had a question. And then Chill has a question. So, folks, type in the chat box if you have a question right now. We'll go to you live. The markets are reeling. What do you do with your money? We have Christine who has a question on protection in these uncertain times. I'll talk about that. Give us a call, folks. 888-988-JOSH. We'll be back after these messages. 888-988-JOSH. 888-988-5674. And we're back. This is Josh Jalinski, the financial quarterback. We're going to go to your questions. So come up, raise your hand if you have a financial question. Christine had a question on what to do with her money, so you can ask it now. Go ahead, Christine. Go ahead, Christine. Her question was, how does one protect oneself if one has investments in real estate, stocks, and cryptocurrencies? Well, if it's cryptocurrencies like dumb ones that are Algorand or Cardano, I would get the heck out of that stuff, because stuff is gonna go to zero because it's nothing. Bitcoin's different. It's a long-term asset. Stocks, if you have blue chip stocks, generally 10 years from now, if you have a long time horizon, you should recover. Although I believe in the next 1 to 3 years, we may have significant economic pain. So set up a volatility buffer. That could be comprised of treasuries, cash, fixed assets, fixed annuities, cash value insurance, things that will not go down if we have a recession or a depressionary level. There could be significant pain. So somebody said debt to GDP ratio is 128%. I do think that, people not distinguishing between crypto from Bitcoin will cause massive amounts of economic pain. Just think about how much was wiped out in one cryptocurrency. How much wealth? Well, I don't. Does anybody know that number? How much wealth was wiped out of probably, saps who bought Luna? I don't know. It's a lot of money. And that's just one. Over 15 billion has been wiped out. So imagine you were putting $10,000 into Luna. That was all you had because you thought it was going to be the next dollar, the next Bitcoin, and it ends up going to hell. It's crazy. Now, Rico says this. Does the Fed really care or want to get out of this? I think they want a soft landing. They want a soft-ish landing. The question is, will they achieve it? If they do, hooray for them. I personally think that anybody at the Fed obviously has motives. I mean, it's not a job that you would normally want. Everybody's trashing you for how bad the economy is doing. Now, this is another guy, Philadelphia Fed President, Patrick. So this show could be called Fed Presidents and Their Hawkish Statements. Every Fed president that I am reading, Fed President Harker, is saying the Fed will keep raising interest rates until it is confident that inflation is moving down. It's a very real problem. And I think they knew that the inflation was generally caused by supply chain issues and all of these exogenous events like Russia, Ukraine, COVID, but they didn't want to appear tone deaf. Because if you read Chairman Powell's statements, he's threading the needle. They all seem very sensible. So they can't stop raising rates without a data point. They need some data point that looks like it's external for them. And they want to see inflation come down. And if inflation starts coming down next month, the month after, the month after that, well, then they can say, well, we're going to stop raising rates and then the markets will rally. But by that time, will the market go down to 3,000 on the S&P, 3,450 on the S&P, 25,000 on the Dow? I don't know. And I know, Tina, you've been talking about this for quite some time, that the Fed made the wrong move, largely because, they wanted to, I guess, appear like, why would they have done this? Do you think it was just to appear that they were politically sensitive? I don't know. What do you think? So it's tough to judge people's motives, but what would you say, Tina?
I think they got a lot of pressure from the administration. I tend not to think that this is, as people like to consider it quote unquote money printing. It's based on decades of bad policy. I disagree with you on the pain, by the way. I do not think we should take that pain. I actually think at this point we have pretty much no choice but to continue to kick the can down the road, because I don't think you understand what you're signing up for. And I actually disagree with that view. I think you're signing up for something that people don't begin to understand. I really do. I think it's a really serious problem, and I don't think we can take it culturally.
No, I agree with you there. I just
So
think that's the only thing that
I don't think it can be worked out that way any longer. I think that was something could have been done decades ago. I think we are decades into mistakes, decades. So it's really a long discussion. It's not easily addressed on a radio program.
Well, I think it could have been. I think I was talking to Lacey Hunt. This was in the middle of the COVID meltdown where the S&P lost 37% in a month. He was giddy a little bit because he thought that the austerity that was necessary to stop the negative effects of debt was thrust upon us. It was really a once-in-a-generation opportunity where people were investing, they were saving. And because they threw so much money at the problem, it actually fostered bad behavior. Instead of building that savings, people bought dumb cryptocurrencies. They bought dumb meme stocks. They actually destroyed that opportunity because the government handed out money. If the government would have embraced some of the austerity, sure, we would have had pain, but I think we could have gotten through it under the guise of we're all in this together with the COVID thing. I do believe now that would be politically untenable. We'd probably have riots in the streets. It probably won't happen. To be frank, I think that's what the Fed's been trying to signal with that soft language.
I think it's too late.
Soft landing.
And I don't think we're going to have a soft landing. I don't think it'll be soft at all. And I think we're going to see spending, which makes COVID look small. And I think we'll need it. I think the things that you might have thought are possible and Lacey Hunt thought were possible, I think these things, I think that ship sailed decades ago.
No, I agree.
I really do.
Yeah, I agree.
I think it sailed
2020,
decades ago.
though,
and
I would disagree in this point. I think in COVID 2020, people were saving. The savings rate was going up until we started, rewarding dumb behavior and giving handouts that didn't make any sense. And I think that was a moment. The moment has passed. I probably agree with you now that we really can't take that. And I think the Fed or the U.S. government will do whatever they have to prop things up. I've said that I think they'll start buying indexes at the next crash if they have to. Whatever they have to do to provide liquidity. 82% of the market is traded now on passive indexes. I've been calling this for 2015. Since 2015, I thought we would have a crash due to everyone being in indexes. And maybe that's the thing, maybe, where we see these massive sell-offs that go so much quicker than they used to, because now instead of a bear market being a 20% decline over a year, it's a 20% decline over a month, because everybody has a 401k and they can just hit sell, sell, sell. Everybody has a cheap index fund.
That's not the likely scenario. The more likely scenario, from what I understand from people who've done work in this, is that as people lose their jobs, they won't be continuing to invest in their 401ks. So it's actually just, it's not that they sell necessarily, it's that they stop buying
as much. They create, they don't create that put effect on the market. So still most people, it's funny, but by me gauging people, unless you're really in this, not many people are worried about it right now. That's what actually makes me bearish, that the people in the know are worried. And once it hits retail mainstream, usually it's too late. I mean, it's too late now because the market's already dropped 20%, but there could be another leg down on this thing. So we'll go to your questions, folks. If you have a question, I got about 6 more minutes left. If you have a question on stocks, bonds, annuities, mutual funds, I do think they care. I just don't think I don't know if they're capable to do what needs to be done. And I don't even know what could be done, like kind of what you're saying. So, folks, the S&P is at that critical 38-ish level, 38, 37, down about 162 on the day. Massive sell-off in equities again. It used to be that a 400-point drop in the Dow was a big thing. Now it's kind of a daily recurrence. So what are some financial tips to endure hardship? Number one, make sure I would end with the letters P, S, and G. Protect, save, grow. Too many people rely on GoFundMe pages when their spouse dies to care for their children. You should have insurance. You should have disability insurance, life insurance. You should have an emergency fund of at least a year in cash to weather so you can hodl risk assets. But realize if this is truly a bear market, things could fall far. Also look up, if you have a plan, if you've protected your family with term insurance, disability insurance. My father is one of the reasons I got into financial planning. He had bought into the market in the 90s when everybody was buying in. And then he got disabled and he had to sell his stocks because he was disabled. And if he had disability insurance, he wouldn't have had to sell his stocks. And he wouldn't have had to make dumb decisions. So make sure you have appropriate car insurance, home insurance, disability, emergency funds. Keep saving 10 to 15% of your pay. Dollar cost average still. But then also employ tactical risk management strategies. Be mindful of moving averages. Simple ones, a 200-day moving average, or 200-week moving average, 15-week moving average, 30-week moving average. If you need help employing risk management strategies, we can help you with your portfolio at 888-988-JOSH. And realize nothing is a perfect risk mitigation tool. Somebody has a comment on disability that says disability insurance is the bomb. Well, yeah, because think about this may be depressing sounding, but what's the worst that can happen? Okay, the market can crash, so you should have a certain amount in treasuries or cash type assets, whether it's annuities, insurance, treasuries, cash. Those should do well in a recession. You should have certain risk assets, stocks, Bitcoin for the long haul, 5-10 year out, because we'll probably recover 10 years later, 5 years later, whatever it be, will come out of this. We always do. As humans, we tend to view things more pessimistically, and then a year or two from now, something passes. There's something else to worry about. But insurance is critical. Having a volatility buffer is critical. That way you don't sell your risk assets in a decline. That's a big tip. So I got a comment, disability insurance is the bomb. Actually, it's just the bomb in general. Even if your job pays some dinky little disability policy, it is still worth getting your own. That is a good tip. Because most of you, let's say you make $200,000 a year from your employer, decent salary. Most disability plans will only cover you up to 60% of your base pay up to $100,000. So you can have your base policy at work, but make sure you buy a rider that goes on top of it. Also, make sure you have term insurance equal to 20 times your salary. There are certain things that you still need to do from a blocking and tackling perspective, whether we are in a recession or not. Market is rallying as we speak, down from as low as 2.21%, now down only 1.38. So hopefully today is the least of the pain for a while, but you never know. I also think basically the reason you've seen the sell-off this week is due to two things. These Fed people basically saying they're not stopping. And then the Scott Minerd, Art Cashins, the Kramers of the world waking up and, it's a bear market, run for the hills. You got to realize though, tune off the TV, get a financial plan, get one that assumes the worst. Would your plan literally go through what stocks would be valued at if we went through a 20s, 30 style, 40 style, worst case scenario, or a 2010 lost decade? Model that out. We have software where you can model it. And then model out your more conservative assets. And you should be able to draw from your conservative assets for the next 1 to 3 years so that you don't need your risk assets. That's my tip I'll leave you with. Folks, give us a call, 888-988-JOSH. Remember, have sound principles of financial planning. Have insurance, have disability insurance equal to 2/3 your pay. Have term insurance equal to 20 times your income. Have a will in case you die. Who's going to take your kids? Have a volatility buffer of 1 to 3 years in cash, in treasuries, in whatever it is that's secured against a market recession or even worse. So give us a call now, 888-988-JOSH, and I will score your top 3 assets from a perspective of risk, fees, and taxation. 888-988-JOSH. I want to thank you all for joining us. Reach out if you have any questions, 888-988-JOSH. We'll be back tomorrow, 9 a.m. live on Clubhouse, YouTube, NWR Financial Radio. We'll be back tomorrow, 9 a.m. I want to thank you all for joining us. Thank you, Bitcoin Tina. And any parting thoughts, Tina?
I think that we've suffered pretty significant downturn already. I would kind of tame the aggressive talk out of the Fed. I think that we'll do a better job solving our supply chain issues by things which make it easier for companies to work on this. I think this can be done by government helping to make it easier for companies to solve supply chain issues rather than trying to engage in demand destruction by basically trying to kill the economy with aggressive policy. So I think these things can be done. I think we can call an end to this aggressive Fed action, what's being promised. And I think that the American business people can respond well to these things if given a chance. Punching them in the face is not going to be the solution to solving these supply chain issues. That's just my opinion.
And a great way to conclude, folks, also get my book, Retirement Reality Check. Go to retirementrealitycheck.com. We'll do a show tomorrow. Thank you all for joining us. Have a great day.